Hi everyone, good morning. So today we are doing the leverage buyout series. This is episode 034 and my name is Deepak Best. So let's get started. So previously we have completed till question number 6 and today we are going question number 7 onwards. So question number 7 is just like a normal merger and acquisition deal, can you structure a LBO, leverage buyout, either as a stock purchase or as an asset purchase? And can you also use section 388, 338, subsection H and clause 10 election? So we have previously discussed about section 338 and we have discussed about stock purchase and asset purchases. And we have also discussed why seller, what a seller prefers and what a buyer prefers. So before, okay, let's discuss about the question first. So in an LBO, you can buy a company in two basic types. So think of it as buying a company or buying like a house. So you can do is first you can do is a stock purchase. So stock purchase means that you are buying the whole house as it is and everything inside it also. So furniture, problems, contracts, lawsuits, everything. So you are buying the stock purchase. So that's what a stock purchase means, that you are buying everything. So that's why a stock purchase is actually favorable by a seller. And if you think about as asset purchase, so asset purchase is like only choosing the parts you actually want, the garage, and leaving the rest behind. So this is actually favorable to a buyer. So that's why buyers prefer asset purchase, and it also gives them benefits, accounting benefits also. So in an LBO, leverage buyout, investors can use either of these models, and just like a normal business purchase. But what is section 338? So this is actually a special tax rule in the United States, and it basically allows the buyer and seller to pretend they've actually bought a company's asset even if they actually bought the stocks only. So this creates a tax benefit. But the key part here is that this to use this special tax rule, the buyer must be a C corporation, and C corporation is actually, let me just highlight it first. So the buyer must be a C corporation. Understand this thing. So buyer must be a C corporation. And C corporation is a specific traditional type of a company under the United States. So a buyer should be a C corporation. This is the requirement to use 338. And why a private equity firm cannot use it is that the private equity firm usually are not a C corporation companies. They are basically LLCs or LLP, limited liability companies or limited partnership companies. And when they buy the company in an LBO, they normally create a LLC to act as a buyer. And because these are not C corporations, they do not qualify to use 338 H10 tax rule. And this is the main reason why it's not used, because of the tax government rules. In simple answers, you cannot use section 338 election in an LBO because the buyer in an LBO is not a C corporation. It's an LLC set up by the private equity firm. And 338 is a tax trick allowed only for C corporation buyers. And private equity uses majorly LLC or limited liability or limited partnership, not a type C corporation. and therefore they cannot use 338 subsection H and clause 10 in uh, leverage buyout. So the key takeaway here is that while 338H can provide a tax benefit in traditional merger and acquisition deal, it is rarely applicable in LBOs due to private equity firms' typical legal structure. All right, so I hope this is clear. This made sense. And these are traditional companies. C corporations are actually, from America's perspective, United States perspective, these are the traditional companies which comes under US law. So that's why a C type corporation can only use a LBO, Section 338H and 10, not other companies. And we are discussing this everything from a US perspective. So let's move to question number 8 now. All right, so question number 8 is actually a great question. So question number 8 is about walk me through how you calculate optional repayment on a debt in an LBO model. Calculate optional repayment on debt in an LBO model. So an LBO company has several types of loans. So every month or every year, after paying its required expenses, it uses extra cash to pay down these loans in specific order. So they actually require to pay the payments first, which is mandatory, and they use the leftover cash to pay down other type of debts like first, they will pay the revolver based on the seniority. Then they will pay down the term loan A, term loan B, and high yield bonds cannot be prepaid, so they can skip them. In simple analogy, think of it like a personal debt. Imagine you have a credit card, which can be a revolver, which mimics a revolver, a car loan, which will be a term, which can mimic a which is an example of term loan A. Student loan would be an example of term loan B, and a mortgage you cannot prepay, and which was a high yield debt. So every month what you need to do is you make minimum required payments on each loan, and after that whatever cash you are left, you can go forward paying off loans faster, and you always pay off them in a certain order. So first is determine the cash available for debt repayment. So figure out how much extra cash you have first. So you can start with the beginning cash. How much money you had at the start. Minimum cash means that what you must keep for safety, like emergency savings, and cash flow generation during the year, and subtract the mandatory debt repayments. So this will actually the remaining amount would be your cash you can optionally use to pay debt. This would be here is this formula also. So we have also created a formula. The cash flow statement, typically net income plus non-cash expenses, and we subtract the capital expenditure and the working capital changes which are required. And whatsoever is left after this, after the mandatory debt repayments, that is your cash available for optional repayment. You have an option whether you want to do a repayment or not. And in second step, you pay down the revolver like credit cards first, the which are in the topmost in the seniority. So revolver is actually like a credit card, and you borrow it. You borrow from it when cash is short and repay it when the cash is available. So that's a revolver. So you want to replenish the whatsoever you have spent from the revolver uh, first, so that in future when you require the loan or require the money, so you can always contact the bank about the revolver. So the rule is that if you owe anything on the revolver, you use extra cash to pay that off first, and you cannot pay more than the amount you owe. So whatever cash you use here reduces the cash available for the next step. So if whatsoever was available for you, you have paid the revolver first. Now you have lesser cash, lesser money available for you to pay the other 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 debt. So then you pay optional amounts on the term loan A based on the seniority. So you have already paid a mandatory portion, but now if you still have extra cash, you pay as much as of the pay as much as of term loan A as possible. And again, you cannot pay more than the remaining loan balance, and whatever you pay reduces your cash available also. And afterwards, you go towards the term loan B. So you have paid already. A term loan B is like a student loan with fewer requirements, and same rule also applies here that you can use any leftover cash to pay this down, and you also consider mandatory repayments that were already made. And but after this, after term loan A, whatsoever high yield debt you have left out, high yield debt is like mortgage with no premium, no prepayments allowed. So you cannot pay your high yield debt immediately. Uh, So you must pay only what the contract requires and nothing more. So optional prepayment is zero in the high yield debt, which we have not written it out here. And finally, if we talk about it, so we are paying everything in order of the seniority. So this is the now first we have estimated how much cash do we have. Then we will start with the revolver. We will after that we will pay out our senior secured debt, then we will pay out our senior subordinate, and the high yield debt we cannot pay it, and because it comes with the condition that you cannot prepay them. And so we only need to take care of these loans which we can prepay. The key points here are that the optional repayments flow from the highest priority to the most flexible debt down the stack, and they reduce interest expense in future periods because principal is lower and formula can get complex depending on the model setup. But the logic is always available cash. Then we pay out the revolver, term loan, and term loan B. Key takeaway: the optional repayments are a way to a strategically reducing leverage and interest cost using excess cash flow. And in model, you always apply them from the most flexible to least flexible debt. And every time you pay one debt, you actually reduce the cash available for the next debt also. So this is pretty much it. We have talked about question number 8 now, and I hope this was clear also. So here they are actually testing how much you have understood about the seniority of the debts. We have discussed about this, the seniority of the debt in question number 1 in this series. So let's move to question number 9 now. If you're still confused about question number 8, just I will recommend you to go to question number 1, the previous episodes, and you will get a better understanding of that. We have talked about the type of debts in detail in that series. So question number 9 is about explain how a revolver is used in a leverage buyout. So revolver in a leverage buyout is basically a company's credit card that it uses only when it's temporarily does not have enough cash to make required loan payments. Uh, and think of it like managing your personal finances. Imagine you must pay rent, car loan, and phone bill, but one month you pay one month your payback is not enough to cover everything. You might use a credit card to temporarily cover the difference so you do not miss the payments. And later, when you have extra money, you can pay off the credit card first. And this is exactly how a revolver works in a leverage buyout. So, step-by-step explanation about leverage of a revolver is that the purpose of the revolver is it's a line of credit and not fully borrowed in the start. You borrow from it only when you need it. It's like a credit card. You borrow if you are short on cash. You pay it back first when you have extra cash, and it could be used again later. And when do you use a revolver? So every year in a leverage buyout, the company has to make mandatory debt repayments. So those are minimum loan payments. If the cash If the cash the business generates is not enough to cover those payments, it borrows from the revolver. And the question is, how much do you need to borrow to cover the gaps? And the formula here is the revolver draw is the maximum of zero or the mandatory debt repayments minus the cash available for debt repayment. Either you can draw zero or the mandatory debt payments, we subtract the cash available for debt payments. So understand this thing. If the mandatory debt payment, if this number gets negative, so zero will be maximum. But if we have some amount of debt, like, assume that it's 100 and we have a cash available for debt payment is 50. So 50, if we subtract 100 out of 50, so 50 would be the number, and we have two choices, 0 or 50. So the maximum of 0 or 50 means 50 we can draw from revolver. So this is basically simple, and don't get confused when you look at this formula. Once your debt once your debt is settled down, or it you have surplus amount, then this number gets negative. So 0 will be maximum because 0 is still positive numbers. Just don't get confused when you're looking at this formula. Just understand what the formula is talking about. So either it could be 0 or it could be a negative number. So negative number would still be smaller than a 0. So the maximum number in that case would be 0. And this can also only happen when you have completely paid down your debt. So whatsoever amount is left, you will draw it from the revolver. So in plain English, if you have enough cash, borrow 0. And if you don't, just borrow just enough to fill the gap. Revolver actually starts at 0 means if the revolver stays undrawn, so it just act like a credit card. You do not own anything at first. You only owe something if you use it, and if you don't use it, there is no cost. So revolver starts with zero balance. You can incur a balance and start paying interest when the company actually needs the cash. This is exactly like having a credit card line. You do not pay anything unless you tap into it, and after that. Uh, Add revolver borrowing onto your cash calculation, and if you use the revolver, the borrowed amount become extra cash. The company can use it to make its required payments, and this makes sure the company never runs out of the cash on paper. uh, and revolver is always repaid first when there is extra cash. Once the business generates extra cash beyond it what it needs, it pays off the revolver before anything else. Why? Because revolver is actually a debt. It's flexible, short term, and usually more expensive, and it's meant to be paid off quickly. And only after paying off the revolver, you pay down the term loan A, term loan B, and you cannot prepay the high yield debt. So in seniority, we always pay the debt as per our senior as per the debt seniority. So revolver comes first, senior secured, which is among the senior secured loans. Senior secured form of debt, then the senior unsecured, then the subordinate, and then the unsecured. Just remember this pattern. And the final summary is that the company has payments if it must make every year. Uh, if it do not have enough cash, it borrows from the revolver to cover the shortfall, and the revolver starts at 0, and is only borrowed if needed. When the company later has excess cash, it repays the revolver first. And after the revolver is fully paid off, any leftover cash can go to other loans. So always remember a revolver like a credit card. So credit card, the way the credit card works, it facilitates you. So does the revolver for a company. All right, I hope this was clear. So we have covered till question number 9 in this session. I hope we have discussed everything. All right, then. Thank you for attending the lecture, and I will see you guys in the next reading. Thank you.